All right. Well, again, welcome. Thank you for joining us today. My name is Jeff Burney, Chief Client Officer here at Curi Capital, and I'm joined by my colleague Chris Graff, who's our Chief Investment Strategist. So today we are together here to discuss the One Big Beautiful Bill Act. So this is a follow-up from the note that we had sent on July 10th, where we had outlined a lot of the specifics there, but wanted to give an opportunity, given the complexity and the impact, both on the planning and the investment side, to get clients together to answer and address questions and give you an update now that we've had a couple of weeks to be able to go through things. This is a big week in the market, so we're not going to spend much time talking about things outside of this bill, but wanted to highlight that we have been getting, there's a lot of economic data coming out this week around employment, GDP, inflation news. We've got 40% of the S&P 500 company earnings being announced. And we've also got a rate decision by the Fed on Wednesday, which is much anticipated to be the fifth meeting of holding rates steady at that 4.25% to 4.5%. So there's a lot of news out there. At the same time, we're getting a lot of tariff news or conclusions there for some of the countries with the deadline of August 1st, which is this Friday. So just recently saw the news around the EU and talking about the agreement there of the 15% tariff on imported goods from the majority of the European Union, as well as some investment opportunities that they're going to be making in the U.S. Japan came in the same. We've had UK and Brazil, and the big ones that are outstanding are Canada and Mexico. And I think a lot of the good news there is that they're trending lower than what they were initially anticipated to be. So we'll see how that impacts some of this economic data, and Chris will certainly touch base on it as well. We can flip to the next slide here. So for everyone that's joining us, not everyone knows Curi Capital as well as our clients. So I wanted to give a brief update here. So as of today, so slightly updated numbers since 6:30, our assets under management have exceeded $14.25 billion, which is a high watermark for us as a firm. So we're incredibly proud of that, and very grateful for the trust and confidence that our clients put with us. Overall, our organization, we cover 3,000 plus clients across our 10 offices. There's 175 employees, and the real takeaway here is we're a team-based culture and organization. On the next slide, I'll just give you a brief overview of what it is that we do. So there's really four core offerings that we have. And we're really, the main takeaway here is that we're, managing money for our clients, and our clients really run the gamut across the wealth spectrum. So helping those that are starting off and starting to save, all the way through our ultra high net worth families, and then helping small and medium-sized companies with their retirement plan solutions and benefits. So taking us to the next slide here. I wanted to just give you a quick overview of the agenda. So we've set this meeting for about 45 minutes. The key topics that we're going to discuss here are all related to the One Big Beautiful Bill Act. The majority of that is, as you all know from our summary email, is really the making permanent a lot of tax changes. And that word permanent keeps getting used out there. And I think it's worth a disclaimer to say that the permanency of it is, with the administration. So all of these things can change over time as they've done in the past. But it's important to note that a lot of these things are intended to be permanent and not change or sunset. But that, can always be changed in the future. So we'll review a number of slides here. That'll be about 15 minutes, and then we will leave the majority of our time for Q&A. So we have received a number of questions in advance. So we've got answers to that. So both Chris and I will address those together. And then there is a Q&A button at the bottom of your screen. And so if there's any questions that come about or need for clarification, please feel free to enter them in there, and we'll do our best to get those answered today, or we will follow up with you individually to make sure that those are answered. So with that, Chris, I will pass it over to you.
Thanks, Jeff, and thanks to everyone for joining us today. As Jeff mentioned, we'll cover a few slides here to just share some high-level perspective and start to get into answer some of the questions that we received along the way. So we'll really talk about the impact of the bill, broadly speaking, kind of taking it back to the highest level in terms of its impact around government spending and what that means in terms of total federal debt burden. We'll talk about some other things around the edges as well. So this chart really gives us a sense of the annual budget deficits that the federal government has incurred going all the way back through the 1970s. And you can see that but for some period of time in the late 1990s, the government has been spending, deficit spending, consistently year in and year out. The dotted line on the far right-hand side gives us some estimate or projection of the impact of the budget bill with the red bars that are attached to what was the current trend line for deficit projections already. So the big picture here is that the budget bill really doesn't change the dynamics in any significant way related to federal deficit spending. And what does that mean? It just means that the government is spending more than it receives in income every year. And in order to fill that gap in terms of the amount of spending that's being done relative to the total amount of revenue or income generated, the government needs to continue to borrow money from different places. So the bill is projected to add roughly on a net basis $3 trillion to the deficit over the next 10 years. So let's dig in a little bit to understand exactly some of the key components of what got done with this big budget bill. So on the left-hand side, we see a breakdown of some of the major components, as Jeff mentioned, a more permanent extension with this administration for their previous tax cuts, and then some changes around the edges in terms of standard deductions, tax credits, immigration spending, and so on, offset by some cuts related to Medicaid and so on. So these are the big elements of the bill, and when you net it out, again, it results in about a $3 trillion net increase to the deficit over the next 10 years. Now, that's the really high level. It's very nuanced when you start to go through some of the different measures. Some of them are more temporary. Some of them are phased in over a period of time. Some of them don't phase in until after 2026, which would be at post the midterm elections. Some of the initiatives are really specifically targeted at different sectors, which we see here on the right-hand side. So there's a lot going on in this big bill. It's hard to look at the bill to have one big overarching theme other than to extend the tax cuts and to provide some incentives, especially for corporate America, to continue to spend and invest back in the economy. The challenge is with that amount of deficit spending happening and the amount of incremental debt that'll be incurred related to this big budget bill, how is that gap going to be filled? The debt burden for the U.S. economy, for the federal government, is on an unsustainable path, as we've talked about before. And one of the big things that this administration seems to be doing was try to fill that gap with tariff-related revenues. So Jeff mentioned some of the headlines around that recently. This chart is a nice summary of some of the different state of things a couple of weeks ago. And it starts to show you on the left-hand side the pickup in tariff revenues on a monthly basis over the last couple of months. The short story here is when you add up a couple $1 billion of tariff revenues on a monthly basis, it's still not a lot in the grand scheme of things relative to a $3 trillion incremental increase in the overall deficit. So this has really impacted how the financial markets have thought about the impact of the budget bill, the impact of tariffs, and what the ultimate longer term and shorter term consequences might be. We've had a lot of questions around the impact around the bond market. We've had a lot of questions around the impact both around short-term interest rates and longer-term interest rates. So this chart tries to give us some trend and gives us an ability to try and talk about what's been happening more recently. So this chart shows the trend in 2-year Treasury yields, 10-year Treasury yields, and 30-year Treasury bond yields going back to the start of the year. And you can see in the middle of the page the spike that occurred at the beginning of April, sort of a downdraft and then a quick updraft in all maturity spectrums, short, intermediate, and longer term. What's really interesting is you look at the trend in the bottom yellow line, that 2-year sort of shorter term interest rate level. That shorter term level is really sort of controlled by monetary policy and what the Federal Reserve is doing. And so you can see after some volatility there in April, it's sort of in a flattish trend. But if you look at the green line on the top, you can see that after the initial downdraft, a significant spike in the 30-year Treasury yield, and it's been in sort of an upward trend since then, reaching 5% along the way and kind of bouncing closer to those levels. So one of the questions we've received is just how has the bond market responded? And we'll get back to that question in a little bit. but you can see it's fairly nuanced between shorter term yields and longer term yields in particular. Now, the challenge has been with an increase in the federal debt burden along the way, that level of federal debt has become relatively unsustainable. We've talked about it in past webinars and market outlook presentations, but it continues to increase every year. And at last count, it was approaching $36 trillion, which was over 100% the size of the US economy, over 100% of GDP. And the interest level on the debt was now approaching $1 trillion a year all by itself. So with the bill not really accomplishing too much and changing that dynamic, and if anything, making it a little bit incrementally worse over the next few years, the administration has been looking for different ways to help support the refinancing and new maturities and issuance of US Treasury bonds, the main form of debt in terms of how the government borrows to fund the deficits. One of the recent measures that the administration has taken is to loosen the standards around capital ratios for the bigger banks in the financial markets. So this chart gives us some sense of how the debt held by the public, the federal debt held by different components of the public markets, whether that's in the Federal Reserve or mutual funds, pension funds, or foreign countries. It gives you some sense of that on the top and shows you the level held by banks at the bottom. The recent loosening of standards around some of the leverage ratios and capital ratios will encourage banks to own more treasury bonds or give them room in their balance sheets to be able to hold more, and that'll help support what the Treasury, the US Treasury needs to do in terms of refinancing some of the shorter term maturities. Another thing that the administration has been doing outside of the budget bill, it was recently around what was referred to as the Genius Act. And that's really helped support the development and creation of stablecoins, which are a form of cryptocurrency that's backed by treasury bonds or treasury bills, really short-term treasury bills. So the chart on the left-hand side here gives us a sense of the major foreign holders of US Treasury securities by country. And then the yellow bars start to show you where some of the stablecoin providers are starting to show up in the mix in terms of their size. With the Genius Act getting passed most recently, there's good support from a legislative standpoint to see more stablecoins being issued, and that should provide some short-term support, especially at the short end of the bond market, to continue to support what the Treasury, the US Treasury needs to do in terms of refinancing. So incrementally, while the budget bill incrementally makes the debt load even bigger, the Treasury is trying to do some things to help ease the shorter term refinancings that need to take place, and that's being reflected in the bond markets as well. We've used this chart before to just sort of summarize big picture perspective, how to think about what's been going on this year. On the left-hand side, you can see risk assets broadly characterized by the S&P 500 and high yield bonds. In the middle, we've got treasury bonds, both short-term 2-year treasury yields and 30-year treasury yields. And on the right side, we've got other asset classes and other assets that give us some signal about how to interpret what's happening in other parts of the markets, the US dollar on the top and gold on the bottom. What's interesting here is that all of these leading indicators, these market-based indicators, are telling us different things. Risk assets recovered pretty quickly and aggressively after the trough in April. Treasury yields, short-term treasury yields on the top have moved sideways. Long treasury yields have been increasing over time. And at the same time, the dollar's been going down and gold has been going up. So that tells us that during sort of the concerns in the market about the level of uncertainty related to tariffs and the budget bill, that there was more going on there than just sort of the short-term impact of that uncertainty. With the 30-year treasury yield continuing to rise, which reflects some concerns about inflation potentially and some concerns about other risks and the sustainability of the debt, while the dollar's been going down and gold has been going up, that really tells us that there's an opportunity here, or there's an urgency to continue to diversify asset allocations to prepare for a wider range of outcomes. So what's really interesting is the strength of the recovery in the S&P 500 in that upper left side of the chart. You can see that it's been a pretty strong rebound since the bottom, that trough in April, while some of the other markets have continued on the same downward trends that they began in April. So two different sort of stories and narratives here. And we think, again, the opportunity, not knowing exactly how it'll play out and the things that need to be addressed longer term in terms of economic growth and debt sustainability, we would continue to recommend increasing the level of diversification across asset allocations. Now, what could be causing risk assets on the left-hand side to be recovering more sharply than what we're seeing on the right-hand side of this chart? Well, there is one big factor out there that, of course, has been top of mind for investors since maybe a couple of years ago, but that is the continued adoption, more widespread adoption of AI in terms of improving productivity gains throughout different parts of the economy and many types of businesses. So this chart is an interesting summarization of the impact that AI is having across different types of tasks on the left-hand side, and also in terms of retooling in the job market on the right-hand side. So there's a broad concern that AI will eliminate jobs and will cause unemployment to rise. What's more likely to happen is that most companies and businesses, different parts of the economy, will start to rethink how they leverage this technology and what kind of roles they need in their organizations to take advantage of it and continue to maintain and invest in it going forward to help improve productivity. So this could be a really big long-term tailwind for the economy going forward, but it probably will come with a shorter-term transition, as we can see on the right-hand side, in the change of types of jobs by sector and what those jobs require in terms of being able to leverage technology in the future. So a lot to consider sort of at a very high level as we think about the impact of the budget bill, both in terms of the sustainability of the government debt situation, the annual deficits that they continue to incur, the cost of the federal debt in terms of its crowding out effect on other things that are big spending items for the government, and then how that brings it back to what to think about investment opportunities going forward. So I'll stop there and we'll turn it over to the Q&A. Again, as Jeff mentioned earlier, we did receive a lot of questions in advance, and he referenced the opportunity, if you see the Q&A button at the bottom, to also submit questions along the way. So I'll start the Q&A discussion, and Jeff's back with us for this conversation as well. And I'll turn the first question back to him. We kind of organized the groups of questions that receives in terms of some planning and tax topics and some investment topics as well. So, Jeff, the first question that came in was, for folks over 65 who will qualify for the $6,000 deduction in place of no tax on Social Security, will it be $12,000 for couples?
Yes, the short answer there is yes. So it's a $12,000 deduction for couples. And the one thing to note there, the question was asked here for qualifying. It begins phasing out at $150,000 of modified adjusted gross income for married couples, and then completely phases out after $250,000.
Couple more questions in a similar topic. If you make more than $1 million a year, does the $40,000 SALT cap apply to you if you capped at $10,000 or less?
Yes. So for the SALT tax, this is a state and local tax. So those with over $600,000 of income or more, that $10,000 limit that we've gotten used to over the last couple of years will still be in effect. The $40,000 limitation is phased out after income starts exceeding $500,000. So really, less than $500,000 in income, there's that additional benefit on the SALT side of that $40,000. But above $600,000, it reverts back or stays at that $10,000 level.
The next question was related to tax again. Besides eliminating federal tax, how else does the budget bill affect Social Security in terms of age limits, estimated benefits paid, and so on?
Yeah, so for the federal tax on Social Security wasn't eliminated. It does not change the benefits that are being paid. So in lieu of the elimination on the tax benefits, that new deduction for seniors was an effort to eliminate the tax on Social Security benefits for those in the lower tax brackets. So again, using that threshold there, completely phases out at $175,000 of adjusted gross income for individuals and $250,000 for married couples.
Another Social Security question. How do changes to Social Security impact when it makes financial sense to start to take it and even take it earlier?
Yeah, so the good thing here is the benefits remain unchanged. It's taxed and administered in the same manner as it was before. So the only change under the new act here is the added deduction for seniors to help lower or eliminate the overall federal tax on receiving those benefits. So that was, back to that first question around the $6,000 or $12,000 for married couples.
And I'd chime in on Social Security too. There was some news out in the last day or two about some independent analysis and projections related to the impact of the budget bill on Social Security's sustainability. So now with the reduction in tax rates, which will then reduce the amount contributed back to Social Security, it's now estimated that Social Security will be imbalanced by about 2033 or 2034. So that number, that year, that target keeps moving around, but it's always kind of top of mind for people as they think about how long to expect their benefits for if the situation isn't addressed.
Very good. And then the last question that sort of overlaps between the two of us here, thinking of the planning, the more technical side of the bill, and then taking us into the investment side. So for those of us in the sandwich generation, interested to hear more about the Medicare cuts. So thinking about individuals that are, approaching the age of retirement and moving up, but still taking care of parents that are there. So Medicare was a big part of this bill as far as the cuts that are anticipated. So it's on a federal spending level, it looks like $1 trillion over the next 10 years is what's going to be cut. A lot of that is coming from the federal side and being put back to the states. And so the way that ends up, likely to happen is with different requirements for eligibility, and that may be more dispersed to the states. So a lot of those details aren't there. But the simple things is there'll continue to be headlines and updates is to stay in the know on that. A lot of it goes back to reimbursements for the hospitals and the physicians and the care, and some of that is anticipated to affect more rural areas. So places to start are certainly talking to your physician and seeing if they've got any insight into would they be changing any network coverage or anything like that. And it's looking at these eligibility rules to see if any of these things would disqualify an individual, or if there's changes as to the point in time that it would take effect. So not a lot of details there. Again, it's going to be more at the state level, so it's going to be specific to where you reside. Um, so a lot more to come on those headlines, but certainly something that's important to look after.
And from an investment standpoint, I would just chime in that, as Jeff mentioned, changes to Medicare, Medicaid, and even changes in eligibility and affordability around the ACA, the Affordability Care Act from the Obama administration. So many changes related to some of the big healthcare programs that a lot of people rely on. That's probably going to have to reset how most of the insurance providers and industry providers work, what they offer and how they get reimbursed for it. So it's definitely going to have a change from an investment standpoint as well, in terms of which companies are providing what services going forward.
Very good. So, in turning our attention more to the investment impact of all of this, uh, you had brought up that slide just a couple slides ago, looking at the different markets there. So on the fixed income side of things, the bond market, how do you anticipate it responding to the one big beautiful bill?
Yeah, this has been a very hot topic for many people. We saw some drift in longer bond yields immediately back in April. We've continued to see that upward momentum. I think some people have been surprised that it hasn't gotten worse. I think everyone expects that when there's a moment of concern around the federal government, whether it's a decline in the debt ratings for the debt or some question about the sustainability of the borrowing levels, everyone expects yields to spike instantaneously. What it tends to be the case is that you see this drift, right? What we've seen over the last 3 or 4 months now, where long yields have definitely continued to drift higher, approaching 5% on the 30-year bond, probably will continue to drift going forward. especially as we think about the impact of tariffs, now that that's starting to become a little bit more known and there's more visibility on how it's getting paid for and how prices are either being absorbed or passed through, there's a number of different risk factors to go into the level of yield. So more likely than not, especially at the longer maturity part of the bond market, we'll expect to continue to see bond yields drift higher. Now, at some level, there are natural buyers for higher yields on longer dated bonds. And so those buyers start to come into play, and there's always, this search for equilibrium longer term. But we think long bonds in particular are starting to become a little bit more of a risk asset than what we would have traditionally expected or how we used to think about them as a safer asset. Shorter bonds, short to intermediate bonds, are definitely where we prefer to have client portfolios positioned in terms of their safety and a little bit less volatility going forward.
And an add-on to that, we're taking in some live questions here as well. So appreciate that and continue to add those in there. A couple questions on the, how portfolios, or from an investment perspective, we can take advantage of that weaker US dollar. So highlighting that within there.
Yeah, it's the dollar, the trend in the dollar as the dollar weakens, right? It makes our US export goods cheaper to overseas buyers, right? And vice versa in terms of which way the dollar goes. What we tend to see, what we've seen since actually the beginning of last year, and it really accelerated at the beginning of this year, is sort of a shift in the dynamics between international stocks and US stocks. So as the dollar continues to weaken, there should be some positive benefit for overseas companies relative to US-based companies, and we think that momentum will continue to happen along the way.
Yeah, we've certainly seen that in markets this year already. And along those same lines, we've got the cheaper dollar, which is going to, make our goods more attractive internationally. How would the stable currencies affect that? Does that play into that as far as those
Stable
changes?
coins. Yeah.
Yeah.
Yeah, the best way to think about stable coins is if for those who are familiar with how blockchain works, a stable coin is like a token on the blockchain, so it's transacted along the blockchain instead of through the normal financial channels, but it's backed by treasury bonds, and really more often than not, short-term treasury bills. So there will be some demand as more stable coins are issued to be backed by more treasury bills. So that demand will come at the shorter end of the curve, and as the demand for bonds implicitly creates demand for dollars, it should continue to perpetuate the same trends.
Thank you. All right, moving on to a slightly different topic here. So specifically wanting to know a little bit more about SNAP, which is the Supplemental Nutrition Assistance Program, which was formerly known as food stamps, and how it's been affected by the bill.
Yeah, this was a good question. It's a complicated answer, much like the answer that Jeff and I described about the impacts to Medicare and Medicaid. A lot of the changes to these government programs, SNAP included, are phased in different stages and over different time periods. And a lot of the burden is being put back to the states. So there's eligibility requirements, there's funding requirements. And instead of the federal government taking care of that, a lot of it is being shifted back to each state government. So the impact anyone might see, it depends on where they live, and it depends on how their state might handle it based on the state's current situation with their own budget dynamics. So it's hard to know. There are some immediate changes that are scheduled starting this month, and then it's expected that more work requirement updates will be phased in towards the end of this year, and then cost burdens, the move and cost shift from the federal government to state governments could happen as soon as the beginning of next year. So it's a complicated situation, and it's really going to be a state by state level impact in terms of how each state handles it.
Thank you. All right. So the next question is with a lot of what we've been talking about is, the impact of this bill and, how does that, help and there's been some other changes giving us some breathing room around stabilizing the long-term debt projection for the United States.
Yeah, so in the commentary that we sent out after the bill was passed, I think we made some reference that at least at a minimum, this will give the Treasury some breathing room to help stabilize the situation. And while we think that's true, it's sort of, you can read through between the lines a little bit. We're a little disappointed that they didn't take advantage of the opportunity to do something more constructive. We've been highlighting the unsustainability of the federal debt for many years now. We've been highlighting the unsustainability of federal annual deficit spending. So the challenge now, and with this administration moving in different directions around tariffs and other initiatives, is really on the U.S. Treasury to figure out how to refinance and stabilize the current debt situation for at least the next couple of years. So the good news is the one thing that did happen to help this case was in the budget bill, the debt ceiling was pushed out a significant amount of dollars in terms of the federal limit, which buys a bunch of time for the Treasury to try and do some maneuvers that we talked about earlier in terms of loosening leverage and capital ratio standards on the banks, helping to support through other legislative means more demand for Treasury bills. The question that came in, the point is correct. All that does is give us a little bit of wiggle room. We still think it's a missed opportunity. There's something could have been done more significantly, potentially, but as we've talked about in the past, these conversations, politicians don't just seem to have the will to do the right things to make the long-term harder choices along the way. The question that was kind of around this also made mention of, there really isn't a lot of hope in all this when you think about the tax situation and what the bill is really accomplishing. It's providing tax breaks to corporations and upper income individuals and a lot of benefit cuts to lower income individuals. Hence, it feels regressive. And we would totally agree. There's really no way around that. It's been a challenge. You can see it in a lot of economic data. There's a big bifurcation in the economy between the upper middle class levels that drive a lot of consumer spending and a lot of economic growth versus lower income demographics that are really struggling. And this is just not getting better with this budget bill. That's unsustainable too. Something we'll have to give there in the long term. One thing that we've noticed recently, and I'm sure many of you have noticed as well, but the primary or the election for New York mayor has moved in an interesting direction where there's a declared sort of socialist democratic candidate that made it through the primary and is now, kind of one of the top choices to help that situation. So that's an interesting development that a lot of the political community is watching in terms of where we go from there going forward.
Excellent. All right. So the final prepared question we had here, and then another live one has come in. So I'll get to that in just a second. But with the cuts in science, how does that going to impact the economy in the future, as well as universities and what other types of businesses are going to be impacted that way?
Yeah, this is a fun question because a couple months ago, this was the administration going after Harvard University in terms of its tax exempt status. And then it's turned into different dynamics where research spending cuts are happening throughout the federal government and the university and education systems as well. So there is an issue. There's documented stories now of really good researchers leaving the country, moving to Europe. Some of that might be anecdotal rather than a bigger trend, but it definitely is causing a catalyst for change. I think the hope or the silver lining in all this, of course, was related to AI. So with the broader widespread adoption, especially of generative AI that can accomplish more tasks in a really short period of time, it's probably the case that we're moving towards a situation where the dynamics around scientific research, just development initiatives, were evolving behind the scenes anyways. So this could be a positive catalyst for change, but of course, the federal spending dynamics really change, and that may kind of move in different directions in terms of what's supported being forward. It's unfortunate, but we are trying to think of optimistic ways to think about it, especially with the movement in technology.
Very good. And the final question that we had received here, as other ones have come in, is around the SALT deduction being impacted by the sale of a personal residence. So, not knowing the exact specifics there, we obviously talked about those different income limits within there. It would, be all dependent on, if you're selling the residence and staying within that state, or moving somewhere else. So that's one that we can definitely follow up on in more detail in the personal circumstance, if you just reach out to your advisor. So I'll make a couple other comments here and then turn it back to you, Chris. But as you may have well known and seen here, and certainly from an announcement that we made on July 1st, we are officially Curi Capital. So our name changed there, and that's with our partnership with Curi, who's a medical malpractice insurer out of North Carolina. So we've had this partnership going on for a year and a half, and really proud to be finally with our permanent name there. So that we're very excited about. We will also be, Chris, namely, will be traveling to the individual markets this fall to be hosting our market outlooks. So as you can tell, lots of things changing day by day, week by week. So we'll have a whole fresh set of content there, and no doubt some webinars like this in between as we feel the need to be able to communicate to all of our clients. And lastly, I would say if there are any specific questions that you have that are more specific to your situation, please do feel free to reach out to your advisor, and they will get that question answered themselves, or working with Chris and myself and the rest of the team to get you an answer there. But again, I think all of this just points to it. It's complicated. There's lots of nuances to it. It is certainly worth the discussion and the planning in advance to make sure that we're taking advantage of it from a personal perspective around, how it impacts you as an individual, as well as then the investment front in your portfolio. So please don't be shy with your questions or inquiries, and we won't either, as we share more and more information on this and all the things to come. Chris, anything more from you as we wrap
No,
things up?
that was great, Jeff. Thank you. I'd just add, if you have any other ideas for topics for webinars between now and what Jeff mentioned in the fall, feel free to let your advisor know or reach out to us. We're happy to have opportunities like this to get together to talk about any specific topics that are on your mind.
Thank you all for joining us.
Thanks, everyone.